Friends, in this video we will discuss accounting for depreciation. Previously we had two accounting standard. One accounting standard 6 depreciation accounting, and also we had accounting standard 10 accounting for fixed asset. Both the standards, accounting standard 6 and the old accounting standard 10, are withdrawn consequent to the adoption of the new accounting standard 10, that is property, plant and equipment. Now the accounting related to the depreciation are covered in the new accounting standard, that is accounting standard 10, property, plant and equipment. Now we don't have a separate accounting standard for depreciation. Hence we should know that what is depreciation. That is defined in the old accounting standard 6. Depreciation is a measure of wearing out, consumption or other loss in the value of a depreciable asset that arising from use, effluxion of time or obsolescence through technology and market changes. Depreciation is a measure. Measure means an amount or value or something of wearing out because of excessive usage or something, that is wearing out, or consumption or loss in the value of a depreciable asset. Depreciation will arises only for depreciable asset. What is depreciable asset? We will discuss later. Depreciation arises because of three things: because of usage, effluxion of time or obsolescence through technology and market changes. We purchase a car, we are using that car on road. Depreciation arises because of that. Sometimes we may not be using that car, just we purchase a car. There are some people, they purchase all models of car, just they keep in their car porch or somewhere. They are not using. But even though we are not using that asset, because of passage of time, because of effluxion of time, depreciation arises. And also because of technology and fashion changes, obsolescence through technology and market changes, depreciation arises. So depreciation is a measure of wearing out, consumption or other loss in the value of a depreciable asset that arising from use, effluxion of time or obsolescence through technology and market changes. We should know that why we providing depreciation. What are the objectives of providing depreciation? We will see a situation why we provide depreciation. You are in the business of selling vegetables. Daily you sell vegetables for rupees 1000, and during the year 365 days you sold vegetables for rupees 3,65,000. The vegetables you were purchased for rupees 400 per day, and 365 days the purchase cost was 1,46,000, and therefore you earned a gross profit of rupees 2,19,000 from the sale of vegetables. And also you incurred some other expenses for selling those vegetables. You incurred petrol expenses rupees 5,000, and you paid salary to your driver 10,000, and also some other miscellaneous expenses 4,000. The total expenses comes to rupees 19,000. Therefore you calculated your profit, that is gross profit rupees 2,19,000 minus your total expenses 19,000. You find out your profit is rupees 2 lakh. But for selling those vegetables, you using your van, The van was purchased for rupees 15 lakh during the year. Because of the usage of your van in the business, there will be a loss in the value of the van because of usage, effluxion of time, or technology and market changes. There will be a reduction in the value of the van, and therefore some percentage of that van should be provided in the accounts as consumption of your van in the business. You decided to calculate the depreciation on van at the rate of 10%, and therefore depreciation for the year is 15 lakh into 10%, 1,50,000, and you deduct that 1,50,000 from the calculated profit. Now your actual profit is 50,000, and therefore always we should provide depreciation to know the true income. Like that, we are using lots of machineries, etc., for the production of our goods, and therefore to find out the true cost of production, we should provide depreciation for various assets used in the production. And also our position statement, that is the balance sheet, will not show a true position if you not provide depreciation on your assets. So there are three objectives of providing depreciation. One, to know the correct income, to know the correct position, and also to know the true cost of production, depreciation to be provided. The terminology depreciation, that is normally used for tangible fixed asset, and for intangible fixed asset normally we use the term amortization, and for wasting asset like mines and quarries we use the terms depletion. There will be a doubt whether we should provide depreciation if there is an increase in the market value of the asset. You purchase a car for rupees 10 lakh and the value of the car is now increased to 12 lakh, whether we should provide depreciation. The standard says depreciation to be charged in each accounting period irrespective of an increase in the market value of the asset, and therefore depreciation to be provided every year without considering the increase in the market value of the asset. Depreciation is a non-cash expenditure. Depreciation does not result in any cash outflow. It's just an accounting adjustment entry for providing depreciation. By providing depreciation, it will not result in any cash outflow. It's a non-cash expenditure. When you should start providing depreciation? The depreciation of an asset begins when the asset is available for use. What is available for use? That means the asset is in the location and condition necessary for it to be capable of operating in the manner intended by the management. The asset is in the location and condition necessary for using in the manner intended by the management. The management want to use an item. For example, they purchase a bus. The management's intention is to use the bus as a mobile ATM. The enterprise asks the manufacturer to convert the bus into a mobile ATM. The manufacturer of the bus delivered the bus in the condition necessary it to be capable of operating in the manner intended by the management. That means they converted that bus into mobile ATM, and therefore the mobile ATM is now available for use. Depreciation of the asset begins. When you should stop providing depreciation? Depreciation of an asset ceases at the earlier of the following date. 1. The asset is retired from active use and is held for disposal. And 2. From the date that the asset is derecognized. Whichever is the earlier date, from that date onwards, you should stop providing depreciation. If the asset is retired from active use and you held that for sale, or from the date that the asset is derecognized from the books of accounts, as per accounting standard 10, you derecognize the asset from your books. Whichever occurs earlier, from that date onwards, we should stop providing depreciation. Friends, what is depreciable asset? While discussing the definition of depreciation, we learned that depreciation arises only for depreciable asset. What is a depreciable asset? Depreciable assets are assets which are expected to be used more than one accounting period and have a limited useful life and are held by the enterprise, 1. for use in the production or supply of goods and services, 2. for rental to others, or 3. for administrative purpose, but not for the purpose of sale in the ordinary course of business. The assets are expected to be used more than one accounting period. Then only that will be say that depreciable asset. That will have a limited useful life. Land is not a depreciable asset. Land will have unlimited useful life. And third condition, are held by the enterprise for use in the production or supply of goods and services. For example, machinery we are using in the production, or for rental to others, we purchase lots of car to give it to others on rent, or for administrative purpose, we purchase lots of computers to use in our office. But these are held not for the purpose of sale in the ordinary course of business. If you are purchase it for selling in the ordinary course of business, that is not a depreciable asset. They are called as inventories. The assessment of depreciation is based on 3 factors. 1. Cost of the asset. Second one, the useful life of the asset. And third one, residual value of the asset. We will discuss one by one. What is the cost of an asset? Cost includes its purchase price, what the amount you paid for the purchase of the asset, that is the purchase price, including import duties and non-refundable purchase taxes. That means if the government subsequently give refunds of taxes you paid on import of the goods, that should not be included in the value of the asset. Therefore, you include only non-refundable purchase taxes. And also we must deduct trade discounts and rebates. Basically, its purchase price and non-refundable taxes after deducting trade discounts and rebates. And also any direct cost attributable to bring the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management. What is the intention of the management? how they want to operate the asset in that manner to make it capable of operating in that manner intended by the management. Any cost you are incurred to bring the asset to that location and condition, that all costs can be added to the cost of the asset. Like we said earlier, your intention is to operate the bus as a mobile ATM. To make it to a mobile ATM, you incurred lots of expenditure. All that expenditure can be added as cost of that bus. And third one, the initial estimate of the cost of dismantling, removing the item and restoring the site on which it is located. In previous accounting standard 10, it was not there. It was introduced in the new accounting standard 10, property, plant and equipment. What is that? The initial estimate of the cost of dismantling, removing the item and restoring the site on which it is located. If you have an obligation to dismantle and remove the item and restore the site on which the asset is located. For example, you constructed a plant and there is an obligation that you should restore the site when you leave the site, and therefore any expenses you will incur in future for dismantling or removing the item, you should estimate that amount now as per accounting standard 29, provision, contingent liabilities and contingent asset. You should estimate that now, and that estimation will form part of the cost of the asset. Basically, there are three items in cost: purchase price and duties. Second one, directly attributable cost to the asset. And third one, provision for dismantling, removing and restoring the site. Assessment of depreciation based on three factors: one, cost; second one, useful life; and third one, residual value of the asset. Now we will discuss what is useful life of the asset. It is either the period over which a depreciable asset is expected to be used by the enterprise. How many years the asset is expected to be used, or the number of production units or similar hours expected to be obtained from the use of the asset by the enterprise. How many units you can produce from the use of this machinery, or how many hours you can use the machinery, like that. So it may be the period over which the asset is expected to be used, or the number of production units or similar hours expected to be obtained from the use of the asset. Next, residual value. That is the amount an asset can fetch at the end of its useful life. After the useful life, what the amount the asset can get, that is the estimated amount. We estimate that the van we will get 25,000 rupees after usage of 10 years. If you sell that asset after 10 years, what the amount it can get, that is the residual value. After useful life, what the amount it will get. It is estimated at the time of acquisition of the asset, or at the time of installation of the asset, or at the time of subsequent revaluation of the asset. The asset may be revalued subsequently. During that time, we may determine the residual value. The residual value and useful life are estimation, and therefore both this residual value and useful life of the asset should be reviewed at least at each financial year end, and any change in the residual value or any change in the useful life should be accounted as a change in accounting estimate. The depreciable amount of a depreciable asset should be allocated on a systematic basis in each accounting period, that is during the useful life of the asset. We should find out the depreciable amount. How we find out the depreciable amount, that we'll discuss later. That depreciable amount should be allocated during the expected useful life of the asset as depreciation. Friends, how we will find out the depreciable amount? The depreciable amount is calculated as below. Deduct the residual value from the cost of the asset. You will get the depreciable amount. Find out the cost of the asset. We already discussed how we will find out the cost of the asset. Purchase price including all non-refundable duties and taxes, and directly attributable cost, and initial estimate of dismantling, removing, etc. From that, you deduct the estimated residual value, what the amount you can fetch at the end of its useful life, what the amount you will get for the asset at the end of the useful life, that is the residual value. You deduct the amount from the cost of the asset, you will get depreciable amount. That depreciable amount should be allocated on a systematic basis over the useful life of the asset. So there are three factors: one cost, second one residual value, and third one useful life. Cost minus residual value, that is the depreciable amount. That depreciable amount should be allocated on a systematic basis over the useful life of the asset. Next, depreciation method. There are several methods for providing depreciation, but the method selected that should reflect the pattern in which the future economic benefit of the assets are expected to be consumed by the enterprise. We should select the most appropriate method considering the nature of the asset, the type of the asset, the usage of the asset, and the circumstances prevailing in the business. All considering all these factors, we should select the most appropriate method that should reflect the pattern in which the future economic benefit of the asset are expected to be consumed by the enterprise. How we are using that asset, how the future economic benefits are we consuming. We should adopt a method that reflect the pattern of consumption. But most commonly used method in industrial and commercial enterprises are straight line method and reducing balance method. What is straight line method and reducing balance method? We'll discuss later. But Indian Income Tax Act, the income tax rules prescribe diminishing balance method. The Income Tax Act allows straight line method only for the enterprise they are engaged in generation and distribution of power. All other enterprises should follow diminishing balance method for providing depreciation under Income Tax Act. Once you selected a method of depreciation, that method should be reviewed at least every financial year. Like you reviewed the residual value and useful life, the depreciation method also should be reviewed at each financial year. But you should not change the method frequently. Once a method you adopted, that method should be applied consistently from one period to another. That is a basic principles of accounting, consistency principle. But if there is a change in the expected pattern of consumption of those future economic benefits, you can change the method of depreciation, or if the statute, the law requires to change the method of depreciation, then you can change the method of depreciation. Otherwise, the method of depreciation should be applied consistently from one period to another. You cannot switch one method to another method without any reason. There should be a reason. One reason is that the change, if you change, that will reflect a more suitable pattern of consumption of future economic benefit, or if the method is changed in accordance with the statute, then there is no problem. Otherwise, the method should be followed consistently. There should be a significant change in the expected pattern of consumption of future economic benefits. Then the method can be changed. Otherwise, it is better not to change the method of depreciation. There should be a significant change in the pattern of consumption. If there is a change in the method of depreciation, such change should be accounted as per as change in accounting estimate. You can provide depreciation under the new method prospectively. You need not change the depreciation retrospectively. You can compute the depreciation under the new method from the date of change on the book value of the asset prospectively. No need to go for retrospective recalculation. Next, what are the accounting entries related to depreciation? There are two methods for accounting of depreciation. One method directly charged to the asset account, that is depreciation account debtor to asset. Another method, just open a accumulated depreciation account and credit the depreciation to the accumulated depreciation account. The entry is depreciation account debtor to accumulated depreciation. Every year the depreciation accumulated in the accumulated depreciation account, we will not disturb the value of asset account. Asset account always will show in the as original cost, and for purpose of presentation we will deduct the accumulated depreciation from the value of the asset. We will not charge directly the depreciation to the asset account. That is the second method. But there are two methods. First method is depreciation account debtor to asset. Second method is depreciation account debtor to accumulated depreciation.